He edits the Gloom, Boom, and Doom Report, a monthly newsletter very popular on Wall Street. Marc Faber joins us right now from Zurich. Good to see you, Marc. Even with all of the mess that we just heard about.
My pleasure.
Even with all the mess that we just heard about in Europe, the debt problems around the globe that you write about every single day, you still think that U.S. stocks and stocks around the globe look attractive.
Well, I wouldn't say that they're particularly attractive, but look, I'm in Switzerland at the moment. The 10-year government bond yield is 0.7%, and you can buy quality companies like Nestle, Novartis, and so forth, and they have a dividend yield of, say, 3%. So relative to government bonds, equities are attractive. And if you really think it through, and you're as bearish as I am, and you think the whole financial system will one day collapse, we don't know in 3 years or 5 years or 10 years, but one day there will be a reset, and everything will be essentially started anew. Then you're better off in equities than in government bonds, because a lot of government bonds will either default or they will have to print so much money that the purchasing power of money will depreciate very rapidly.
Marc, financial collapse. You hate government debt of all kinds. If you had to choose, though, between U.S. government debt and, say, Italian or Spanish government debt, which one do you take?
Yes, I'd take the U.S. because they can print themselves out. But I wouldn't take them as a good investment, because I think you have today a yield on the 10 years of, say, around 1.7%, and on the 30 years around 3%. I think eventually in the next few years, yields will be much higher, and the purchasing power of the dollar will have depreciated very significantly. So you give me the choice between Spanish, Italian, and U.S. bonds, then I take U.S. bonds. But otherwise, if you give me the choice of assets, real estate, equities, bonds, precious metals, then I would rather take precious metals than equities.
Marc, it's Eric here. Yours is a powerful narrative, and it has been, frankly, a powerful one for some time. But we've had this conversation before. I remember back in December of 2009 when we were talking about Treasury investments and the Treasury market. You said that Treasuries, U.S. bonds, are poor investments. Now, the story that you outlined for the future was very much the same at the time. Since then, the Treasuries, U.S. Treasuries have been among the best investments out there, certainly in the government bond world. Do you not feel a bit uncomfortable predicting calamity in Treasuries again?
No, actually not, because if we talk about the end of 2009, we still had a very strong rise in equity prices thereafter. And it is true that last year, the 30-year Treasury bond returned 30% total return. That I admit, and I was being wrong. And I also lost a bet to David Rosenberg, and I shall pay him a bottle of whiskey, one of the more expensive brands, if I can afford it. But in the meantime, you know, people in precious metals have done well, and in emerging economies, people say last year was a disaster for emerging stock markets, but Malaysia, Thailand, the Philippines, and Indonesia were essentially flat, and a lot of stocks actually performed very well. So my portfolios in Asia have actually done surprisingly well, and I don't feel that I missed out a lot, risk adjusted, by not being in 30 years U.S. government bonds.
Marc, you're known for your timing and your spot-on calls, the '87 crash, the Japanese bubble bursting. You talk of all sorts of doomsday scenarios for the world economy, collapse, massive quantitative easing. What's the time frame? Because right now it seems like we're just muddling through.
Yes. I'd like to add one more comment about government bonds. You remember, August '99 to March 2000, the Nasdaq doubled. It doubled by 100%. But at no time during that time frame, August '99 to March 2000, was it a good buy. And afterwards, people lost a lot of money. We have today, in my opinion, a symptom of inflation, of monetary inflation. And this is corporate profits have rebounded. They're at record highs. And the second symptom is essentially a bubble. in high-quality government bonds, not in Italian bonds, not in Spanish bonds, but people, they feel so insecure and they are so much worried that they say, okay, I'd rather be in a treasury in America with no yield, 2 years at no yield, or in Germany with negative yields, and get my money back, than in a bond that may not repay me, or in equities that drop 30%. But it doesn't make them a good buy longer term.
All right. Thank you to Marc Faber, the always colorful and somewhat depressing author of the Gloom, Boom, and Doom Report. Thanks for joining us.